If you think what drives gold, you want a lower dollar, you want low real interest rates, you want higher and increasing inflation. And, from 2022 to 2025, we didn't really have that. Mm-hmm. So the environment was not the normal economic environment for gold. And so to me, it's not really a surprise that up until recently, North Americans haven't really been participating. Right. Because the stock market's been doing well, the dollar's been strong, the economy has apparently been strong, inflation has been coming down and apparently under control. I keep saying apparently, but on the surface, things look good, and the S&P was doing well. So why invest in gold would be what most people ask themselves.
Gold suffered its biggest one-day drop in nearly 4 years Wednesday, raising questions about whether a torrid rally driven by anxiety over President Trump's trade policies can continue as the administration appeared to take a more conciliatory approach. The precious metal had climbed on a grand scale this year, culminating in a rise past $3,500 an ounce this week, before support for prices appeared to give way suddenly. The WGC commented, China and Japan dominated demand in March, both likely driven by rocketing gold price performances, which dwarfed other assets in the month, and roaring global trade policy risks. Adrian Day Asset Management's chairman and CEO stresses that the core reasons for gold buying haven't changed. They've only grown stronger. According to Adrian, countries like China and global elites are buying gold to hedge against rising global risks. Adrian notes North American investors remain hesitant, given strong U.S. markets and seemingly controlled inflation. This creates a gap in gold participation. Despite the rally, retail investors are still sorely underexposed. Gold-backed ETF assets currently represent less than 2% of all ETF assets, down from approximately 8% in 2011. Investment in gold ETFs has significantly picked up since February, but holdings are still off by about 19% from their highs in October 2020. Based on fundamentals, Adrian explains that even small bullish news can push gold prices higher in a bull market. He cites examples like Basel III and Chinese insurers holding gold as key drivers. Such factors, once insignificant, now add real momentum. With its full adoption in the U.S. set for July 1, 2025, the reclassification of physical gold as a Tier 1 asset under the implementation of Basel III regulations is a tectonic event for the entire gold market. Concurrently, Adrian observes that today's gold buyers are driven more by geopolitical risks than traditional economic factors. He highlights concerns like dollar weaponization and asset seizures as key motivators, especially for central banks. Before diving into Adrian Day's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Yeah, I think it's like, as with a lot of markets, when you're in a bull market, everything that is marginally bullish becomes bullish and has an impact. Mm-hmm. If this had happened 20 years ago, or certainly in the 1980s, it wouldn't have had any impact on the price of gold. That's the way I'm looking at it. Mm-hmm. But when you're in a bull market, then every bullish factor just adds to the price and adds to the bullish environment. Like Chinese insurance companies now being able to hold gold in their reserves. Mm-hmm. Basel III is another example. So all these things build on each other. The thing I would say just before we get off that and onto equities, I think the big message that I would have is that the people have been buying gold for the last 3 years, and the reasons they've been buying gold have not gone away. Right. If anything, they've only got more serious, but they certainly haven't gone away. Mm-hmm. And so that buying is just going to continue. And that buying also is relatively price inelastic. I don't think central banks who are worried, I don't think China is going to say, let's not buy gold at 3,000, and let's just hope that nothing happens for the next few months. Right. So I think that buying is going to continue. That is the main message. I think you've had different drivers, different buyers, but also people buying for different reasons than they were buying in the 2009 to 2011 or 2001 to 2008 periods. Mm-hmm. They were not being driven by economic factors, but they were being driven by other factors. So obviously central banks, we know why they were buying, to diversify their reserves in the face of dollar weaponization, which I should sort of say didn't start on January the 20th of this year. That's been going on for quite a long time.
Right, especially since the Russian freeze, correct?
Well, I would say even before that, the U.S., the U.S. has liked to exert its influence and power. That's a nice way of putting it. For many, many years. I mean, think of the way they basically told the Swiss that they had to change their whole banking system because the U.S. didn't like what they were doing.
And this goes back to Obama with Bank Paribas, right? The French.
I was going to say there's the Bank Paribas incident. There's the Santander who made a loan to a Spanish company that wanted to build a hotel in Cuba. Perfectly legal under EU rules, perfectly legal under United Nations rules. But the US says, well, we don't like Cuba, so we're going to fine Bank Santander billions of dollars for the... So it's been going on for a few years, but you're right. I mean, obviously the Russian, the confiscation of Russian assets really stepped it up. Chinese, we know they've been concerned about the economy, about the yuan, about the fragility of their own banking system. They're not allowed to buy cryptos, so there are many places that they would want to put their money for security. And wealthy individuals around the world, Middle East, Asia particularly, but also Europe and increasingly the US, are just concerned, as you said earlier, about the imbalances in the world. And so all of these factors are not what I call the traditional economic factors that drive gold. If you think what drives gold, you want a lower dollar, you want low real interest rates, you want higher and increasing inflation. And, from 2022 to 2025, we didn't really have that. So the environment was not the normal economic environment for gold. And so to me, it's not really a surprise that up until recently, North Americans haven't really been participating in the gold market. Because the stock market's been doing well, the dollar's been strong, the economy has apparently been strong, inflation has been coming down and apparently under control. I keep saying apparently, but on the surface, things look good, and the S&P was doing well. So why invest in gold would be what most people ask themselves.
Market analyst Adrian Day underscores that a major missing gold driver has been a U.S. dollar collapse. Despite America's funding issues and declining foreign demand for long-term treasuries, policies like proposing a 30% withholding tax on foreign holders discourage global investors further. A recent CNBC article spotlighted growing concern among investors regarding a potential exodus from U.S. assets as both U.S. Treasury debt and the dollar experience a downturn. The report said that the April sell-off in financial markets has been wider and more volatile than typical pullbacks, fueling concern that the aggressive and constantly changing trade policy from Washington could be doing long-term damage to the financial standing of the U.S. Judy Shelton, a Trump administration official, has advocated for 50-year gold-pegged treasuries, potentially announced on July 4, 2025, the U.S.'s 250th anniversary. Such a move could anchor global trade to gold, accelerating de-dollarization. Interestingly, Adrian Day challenges the mainstream view by asserting that tariffs alone don't cause inflation, unless the money supply expands. He notes inflation is still above target and rising, placing responsibility squarely on the Fed, whose credibility he says is steadily eroding. Let's get back to the interview.
Yeah, no, I agree with that completely. I mean, the one big factor that is missing, or that has been missing from gold, is, a collapse in the dollar. And I mean, we all know why the dollar has held up so strongly over the last 10 years, 20 years. It's because of a lack of good alternatives. What one can't help, I'm trying not to be political, but one can't help scratching one's head if the U.S. has this funding problem, and part of a problem is that they're not getting foreigners to buy long-term U.S. bonds. It's a puzzle why the U.S. seems to be doing everything possible to make foreigners not want to buy our long-term bonds. I mean, there was a proposal was it over weekend or was it Friday, where Miran, who's the chairman of the White House Economic Council or the Council of Economic Advisors, came up with 5 proposals, one of which was to reintroduce the 30% withholding tax on foreigners holding treasuries. Well, that does not make me want to say, let me run out and buy some of these things. Yeah, no, I think the Fed is definitely losing credibility. There's no question that the tariffs, the whole tariff issue and, the back and forth has put a focus onto something other than the Fed. So if the economy slows dramatically or inflation picks up, people are going to point to tariffs. Whereas in my view, before January the 20th, before the administration came in, the economy was significantly slowing anyway. And if you look at the inflation numbers, the price numbers, because that's not inflation, that's the result of inflation. That's
right.
But if you look at the price in inflation numbers, whether it's CPI or core PCE or whatever it is, they've all been trending upwards, slowly, but trending upwards from last June. So, although we look at a 2-year graph and we say, wow, hasn't inflation come down a lot? Well, yes, it came down from a very unusual spike because of COVID. But where we are now, the last 6 months, or really more than that, the last 10 months, it's been trending up, number one. Number two, the numbers are still way above or meaningfully above where they were pre-COVID. And number three, they are, of course, well above the Fed's own arbitrary 2% target. And so I don't think the Fed should be patting itself on the back for inflation. So even if we didn't have tariffs, and I would dispute the fact that tariffs are inflationary. Tariffs are definitely bad for the economy. They definitely raise prices on certain goods for U.S. consumers. And so I've always thought it perverse for a country to want to impose tariffs on imports when it's only hurting their own consumers who want those products. But they're not inflationary. I mean, or I was going to say, as you know, there's different views on this. I mean, I'm a monetarist.
No, I'm very interested. Why do you think what you're in a minority there? Why do you believe that tariffs are improperly billed as inflationary?
Well, because people look at price.
Right.
So if you impose tariffs on Britain or United Kingdom, the cost of my Scotch whiskey goes up and the price of my cheddar cheese, real cheddar cheese, not Wisconsin cheddar cheese, the cost of my cheddar cheese goes up, right? But if the Fed hasn't increased the money supply, if we haven't had an increase in money in the economy, then the price of something else has to go down to offset that.
Yeah.
So we're only focusing on the individual prices that go up. We can only have, or you can't have all prices in an economy moving up unless you've had an increase in the money supply.
Interesting.
And that's Milton Friedman showed us that 40 years ago, and I don't think anything's changed since then. So you can have individual prices going up, but you can't have all prices going up. And that, of course, goes back to it goes back to the Fed. Now, there's other factors, of course. The Fed can increase the money supply, but if the banks simply borrow the money and put it back on reserve with the Fed, then you're not increasing the money in the economy. I mean, the money has to get into the economy. But if the Fed doesn't increase the money supply, it's very difficult to have inflation without the Fed increasing the money supply. So they're the ones that are ultimately responsible for inflation, and they don't seem to. Well, they certainly don't acknowledge their own responsibility.
If analyst expectations come to fruition, further gains could occur in the coming months. Goldman Sachs sees gold topping out at $3,700 by the end of this year, and $4,000 an ounce by mid-2026. With central banks, global elites, and even regulatory frameworks like Basel III aligning in gold's favor, how long can retail investors afford to remain on the sidelines before the opportunity slips beyond reach? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.